Ladies and gentlemen of the real estate world, Santa came early. There must be angels. The elves must love us. Santa Powell, he finally cracked. Boy, oh boy. Honestly, I was not expecting that speech. I was not expecting him to say 3 rate cuts. I was not expecting him to be so dovish. We finally cracked him, and we can finally move on from talking about land the friggin' plane, because I think Powell just landed the plane. And now we can start talking about 2024, how this is going to change things, whether you're a refi, you want to buy investor property, you want to buy primary property, if you're even in commercial real estate, whatever it is, this is going to be a huge game changer for right here between your 2 ears. The mindset of all of us in real estate, because we can prepare, we can plan, and we can start having different conversations now that we finally got over this hump. So let's take a moment of silence and be grateful. Okay, enough of that. What's up, everybody? Welcome back. It's a beautiful week. It's the last week before Christmas. And yes, next week I will still do a brief. I don't know if it'll be from here or my house or in a Santa outfit. I'm just kidding, but it will get done because there's always something to talk about. But this week will be much quieter. I can already see the traffic, the calls, kids are out of school. And it's that time of the year. A lot of people are on vacation. So if you're on vacation, you're watching this, I hope you're relaxing, having fun. Maybe you're in the tropics. Maybe you're in the snow. Maybe you're just in beautiful San Diego. Maybe you're somewhere fun visiting family. But anyways, the news doesn't stop. Real estate doesn't stop. So why should I stop? But anyways, welcome to the brief. Your first time here, welcome. If you've been back over and over, how exciting is this? We've been predicting this moment. So anyways, as I speak, let's just take a look. Let's just be honest and take a look. Because I did say by the end of the year, I just thought the 10-year treasury would be at 4.25. And I know we surpassed that. And currently right now, if my phone would actually come up, I'm sure we're going to have to edit this part to go faster. So currently the 10-year treasury is at 3.954. Honestly, I did not think it was going to go below 4. So look, this is not a great week for these people. And we should take a moment of silence for them too. The house crashers, the people that thought the 10-year treasury is going to go to 7 or 8%, the people that said interest rates would go to 15%. The people that said inflation is going to go to 30%. Sorry, guys. We just got to take a moment of silence. And we want to thank you for relishing in this moment with us. Because you guys, you screwed up and you messed up. But yes, guess what? It's a new year for you too. And we forgive you. And the market forgives you. And let's move on. All right, here we go. You guys know. What do we go over? Inventory. Nationally last week, 546,424. This week, 538,756. This week, 538,767. Of course, we're declining. Let's go through the quiz. Why? Fall and winter is always on the decline. Spring and summer is always on the incline. Best time to buy a house, fall, winter. Worst time to buy a house, spring, summer. Kenny, why would you say that? Because historically, guys, you get the best deals now. Like right now, who wants to move during Christmas week and stuff? I mean, I'm crazy enough, I wouldn't care because it's a good time to do it. Things are quiet, but nobody wants to move. They want to have Christmas parties and, do Christmas and all this stuff. So I get it. So it's time, typically people get a better deal. Here in San Diego, last week, actives were 3,018. We are now sub 3,000, 2,915 active, 280 new listings, 291 recent sales, 320 pending sales. Just want to remind something because we're going to talk about rates. I made this comment and I'm going to make it again. When interest rates were at 2.5, I said, this is unsustainable. This is not healthy. This is going to end. Eventually it came to an end. And when I said a month or so ago, interest rates are at 8, the 10-year treasury is at 5. This is unsustainable. This is not healthy. This is going to end. And my friends, it is ending. It ended. So we are now talking about rates coming down. And what does that look like? So rates from all times high are about, let's say the conventional is 8%. Now it's about 6.6, 6.5. So about a 1.5 off, depending on who you talk to. Rates have come way down. Do not keep thinking we're going to have a straight decline in rates. It could be bumpy. News is bumpy. Data is bumpy. The Fed still will tell you we could still raise. Even though they will cut, they could say if inflation ticks back up, we will raise. I've got my gun right here and I will pull it and I will shoot. He will say that. He will continue to say that because he wants you to know that just if that inflation gets out of control, he's right there to tame that wild beast with his tranquilizer gun, whatever, right? So we know that. But look, what I will tell everybody is, hey, Kenny, should I wait for rates to drop? Should I do, guys, what we just dropped 1.5 points. And all of a sudden, are we greedy? No. If the rate is there, lock the rate. If it happens a free fall while you're in the middle of a purchase or a refi, let us deal with it. Fine. Switch lenders. Fine. Pay, get a float down. But don't play the rate game, because those that play the rate game will get burned. We just had a huge decline. And just to keep thinking it's going to fall off a cliff, no. It will fall off a cliff when data says it needs to fall off a cliff. Do you understand? The feds will cut when data says they need a cut. Right now, they're not. Sure. They're talking about 3 cuts, 25 basis points each. What do I think of that? I think it's kind of like when he said, hey, we're going to raise rates 75 basis points. And he raised them 500. So I don't think that's right. I think he's making a statement. Hey, I'm happy the guy just said he was going to cut. He talked about force. It's premature to talk about cutting. Now we're done hiking, but they won't officially say it. But they're like, we think we're done. We should be done, but we can't just say completely 100% because you never know. But we'll tell you we're going to cut. We think 3 times next year. At least we got something out of them that signals to us we're using our brains, we're understanding the data, and we're starting to be smart about what we say. Could they be too late to the cuts? Absolutely. I would assume they will be. Keep in mind also about interest rates, the 10-year treasury. Remember, we got the 10-year treasury was at 3.9. Let's just call it 4%. And we got the 30-year fixed. Let's just call it 6.5. That margin might have came down a little bit. That margin still needs to shrink. So organically, that could shrink and rates could get better without anything else happening. No rate cuts, no 10-year coming down, no nothing. Just could happen organically over time. So remember that. Economic data this week. There is a lot of stuff going on with homes. So let me tell you what's going on. We've got builder confidence. Housing starts. Housing starts, what does that mean? That means that there's new housing is being built, permits, all that. Permits, existing home sales. We got GDP revised, and then we also have PCE at the end of the week. Big week still, right, for Christmas. This is still enough to move the markets. Remember, some data could come off higher, low, whatever. It could fluctuate traits a little bit. The 10-year could be at 3.9, then it kicks up to 4.17, then back to 3.85, then the 4. So we could be living this little volatility, but guys, we are off that 5%, and we're deciding. We are thinking, right, all of us out here that study the data, that data will continue to decline. Inflation, jobs market's probably going to get worse and worse over the year. I'm going to give you some expectations. I'll probably maybe next week give some guidance, some 2024 predictions on things based on what I'm hearing, what kind of thing people think out there. But regardless, things just continue to get weaker. That should improve inflation. That should improve the data. That should improve rates. But just don't think the 10-year is going to fall off a cliff and go to 3.5 tomorrow. I don't think that's rational unless we get some really, really bad data. So if the data is bad, and the economy seems worse than it is coming into January or whatever, I agree. Like we might see some. So we will see what happens. But like I said, everybody is expecting weaker data in 2024, not stronger. So the big talk of the town for 2024, now that we can start talking about it, is okay, Kenny, okay, everybody. Now the interest rates have declined. Affordability has definitely gone up. I'll go over a couple scenarios I put together. What does this look like? Look, guys, we're still going to have a problem, an inventory problem. Why? Because people are locked in on rates with a 1 in front of it, a 2, a 3, and a 4. From 4% all the way down to where I told you, there's 75% of people or so, whatever the exact number is, that's kind of what we have, are locked in on a 4% or less. 92 are locked on a 5. So if I'm telling you rates are 5s, on FHA, VA, and 6s on conventional, and jumbos in the 6s, maybe high 5s. It's a banking relationship, something like that. That's still not enough for somebody with a 2 or 3. Because remember, not only that house they bought, there were probably 30% equity in it when they bought it. There's that. That would mean they got to sell it. They got to go buy something else. But remember, most sellers are going to be buyers. So as people sell, they have to replace that with another house. The sellers that aren't buyers could be somebody getting divorced, lost a job, death, partner split up, investment property, selling to get out. But that's not all sellers. So most sellers, I don't know the exact number, are going to be buyers. So we need that inventory too. So yes, there'll be a lot more buyers. We're already seeing it off the sideline. Will we have the inventory to pick up? What, maybe an expectation is rates, spring, summer rates continue to drop. A lot of inventory hits the market because it's just sitting here waiting, and we might get a quick pop of a lot of inventory, a lot of people with transactions. Maybe you can get a little deal, whatever, because there's a lot more inventory, but that inventory is not going to last forever. And you're going to kind of just get back to probably low inventory problems. It's going to be it. So when you have pent up demand, you always have stuff that, enters the market. It could have more buyers, more sellers, but we don't know. We don't know if the buyers are going to outpace the sellers. We don't know what this means. So we will have to see, but there could be an opportunity where there's just more inventory and more options for that potential buyer. 2024 is definitely going to be made up of a lot of people refinancing, especially probably the second half of the year when we start seeing rates in the 5s for conventional, and maybe even see 4s for FHA, VA, maybe, because we're like 5.75, 5.625 on VA right now to refi VA or FHA, just FYI, which is huge. So you're going to see a lot of people buying, a lot of people refining, and really saving that money and taking advantage of this in 2024. That will be a big part of 2024. So let me give you an example of where rates have come down. I got two scenarios here. $800,000 purchase, 20% down, payment on 8% was $46.96 as his principal and interest. Today at 6.5%, the payment's $4,045 principal and interest. The difference of that is $651. So from a month ago, if you're buying an $800,000 house, putting 20% down, you're looking at $650 a month savings. Wow. Next scenario, $500,000, 10% down. I'm just doing PI payment, just quick little scenarios, guys. The payment at 8% was $3,302. Today it's $2,844. That is a difference of $458. That is a lot of moolah for somebody. So think about it. 6.5. Imagine if that rate goes down another point. You're talking people saving on a $500,000 purchase a lot more money. Like, I don't know what it is, but it could literally be like, depending how low rates go, $800 a month, $700 a month. It's going to be crazy. So this is a huge deal. These rates coming down, and as they come down the 5s, it is going to be astronomical savings. Affordability is going to skyrocket for people, and people are going to get off the sidelines. If you're a trade-up buyer, a step-up buyer, have you ever heard of this phrase? That means you have a house currently and you want to go buy another house. The biggest problem that everybody I'm hearing is facing is two things. Number one is, how am I going to sell my house and then go buy something else when there's nothing to buy with how competitive? That's number one. That's a problem, right? Number two, the problem is how do I tap into the equity of my house? Maybe I don't want to rent it and I need that equity and to qualify and buy something else, right? So I'm speaking to that person. I want to sell my house. I don't want to keep it as a rental. I need the equity, but if I sell it, I don't know if I can go buy something else. And how am I going to do this at the same time? Nobody's going to accept my offer on a contingent. So what we have is a couple options. Number one, you could get a HELOC. And if you can qualify for both, you can just get the HELOC, pay the house, sell it later. Option number one. Option number two, well, a lot of people are, and I'm not going to get on here and get into the details, but if you're interested, you need to hit me up, is the bridge loan. So a bridge loan is like you have a house here and you have a house here. We need to create a bridge. So how do we basically get equity out of this house to place it over here? Or the bigger issue is, how do we get equity out of here to move over to this house? But how do we not hit you for this payment? Because if you're not going to rent it out and you are going to sell it and you can't qualify for both, you're stuck. No, you're not. There is options. So for the step-up buyer, we can help you with the bridge loan. There's a couple different ways to do it. So if this is something you're interested in, you should definitely reach out. We can have a conversation. We can get you those options. And this is how step-up buyers are winning in today's market. And it is a complete game changer. And it's something you're going to have to do. And it's not going to get easier, my friends, as rates go lower, there's more buyers, because why does somebody want to accept your offer when it's contingent, when they can take somebody else that doesn't have a contingent offer? We need to think about that. It's super, super important to work with the right team, have a bridge loan or have options, because otherwise you're going to struggle buying a new property and getting your offer accepted. One other thing I wanted to talk about, which is a very common knowledge. If you're a first-time home buyer, you've never been through the process, and maybe you're buying your second home, right? I don't care if you're W-2'd, if you're self-employed, if it's an investment property primary, and you want to buy a property, and you went to a bank, you went to a credit union, you went to a lender, you went to a broker, and you got denied, and you think, all hope is over, I got denied, can't get it done. That is the wrong attitude, and I would stop you right there in your tracks and say, did you really get denied? Did you really get a good look at? Were you working with the right person? I get a lot of deals every year. A lot of experienced people that are in my industry, lenders, mortgage brokers, go talk to them. We get a lot of fallouts from banks and credit unions and other lenders that might not have the experience, might not have the product, and might not have the product knowledge in the team to get you approval. So if you got denied by a bank or credit or anybody, that is not where you stop. You need to go find an experienced, my opinion, mortgage broker, loan officer that's been doing this a long time, that's good at what they do. Let them tell you you're denied, because I can tell you right now, most people we get that were denied, we're able to help them out. Or we can tell you exactly what you need to do to get a loan. So don't be discouraged. Don't get depressed. Go find somebody. How do you find them? Go on Google. You can find them on YouTube, on Instagram. Go ask your agents. Go look up their reviews. Find somebody that's been doing this a long time, that's got an impressive resume, and there's a good chance they can turn that denial into a loan approval. So I wanted to throw that out there because there's a lot of stuff going around, but all these people getting denied and you can't get loans and all this nonsense. That is right, but that does not mean it has to be right for you. So there's this video going viral with Grant Cardone on Fox Business. If you don't know who Grant Cardone, look him up. But if you guys are on social, you probably heard of him. Grant raises money, buys apartments, but you know, he's got his foot on the pulse. Let's see what he's saying about the real estate market. Right here, guys. Let's listen to this clip, what Grant has to say.
Yeah, I just want to say that we're entering the greatest real estate correction in my lifetime. It will not include single family homes, but it will include office, which we're already seeing that damage, and we're going to see it across the entire apartment complex. It's going to be a great opportunity for individuals, regular, everyday people to actually grab trophy real estate from institutions. This has never happened in this country. It's going to be at epic levels.
So what Grant Cardone was talking about right there in the last clip of the video, the other stuff you can listen to, it's 4 minutes long. He's talking about how we're becoming a renter's nation, and then that things are unaffordable. We already know all this stuff, and rates need to come down to help people buy homes. But what he was saying in this is that this is going to be one of the best real estate corrections in his lifetime. But in the beginning of that clip, I want you to listen to, he said, not for single family residences, not for housing, not this time. So if you're looking for housing, you think it's going to crash, Grant's saying no. What he's saying is office, maybe industrial or multifamily might see a crash, because what happened is all these institutions, when money was flowing in 2021, 22, they raised all this money, and these guys think they're real estate experts. Sorry to say that. They went out and raised a bunch of money, syndicators, all these people, bought a bunch of property, put it on floating debt. That debt was at 3%. Then it got jacked up to 8 or 9%, and they're building properties. They're underwritten all this, and they basically mismanage them. They mismanage the debt. They mismanage them. They're not cash flowing. They're going to have to give them back to the banks. And people like Grant and other people, big investors, small guys, are going to be able to pick up some of these properties, maybe from lenders or at a good bargain, because people misran the properties, miscalculated the debt, and they're in trouble. So institutional buyers that usually hold on and do this, they're going to have to just like get rid of this stuff off their balance sheet and just say, hey, hit the reset. We lost the money. Let's start over again, and just fire yourself this crap. And that's where he's going to be there to pick up these opportunities.
For many potential homebuyers, the search for a place to call home can be stressful and overwhelming on its own. To add on to that stress, recently, properties have began to rise in California. Brian Dominguez with the Fresno Association of Realtors says this is happening on an even broader scale.
Typically, properties that the scammers are targeting are properties that are not actively monitored by the current owner, and they typically don't have a loan on them. So sometimes they're creating fraudulent deeds where they're trying to deed the property over to their name and then sell them quickly before the title company or attorney or real estate broker catches on.
It is impacting both property owners and real estate professionals across the nation. In 2022, the FBI received nearly 12,000 real estate and rental scam-related complaints with losses over $396 million. That's an 86% increase compared to 2020. Dominguez says there are several red flags to look out for.
They typically never want to meet in person. They do everything through either online communication or voicemail. They call from a burner. They're asking for properties to be listed well below market value and trying to sell them as quickly as possible.
The issue has recently made its way to the Central Valley, hitting the Fresno and Madera County foothills. Scammers committing these crimes use tactics that keep them from getting caught until it's too late. According to the California Association of Realtors, the legal hotline has received several calls from listing agents who have become suspicious that the person who signed their listing is not the actual owner. They recently gave details on what steps you could take if you suspect your client is not the true owner. That includes investigating the property by establishing the property owner's identity, and consider contacting the owner of record directly. That way, you'll know if it's the same person who signed your listing. For potential homebuyers, be aware of last-minute or urgent emails or texts you to change wire insurance. It's also important to note that if you own a property and don't live near the area, to check in on the property often.
So home buyers, home sellers, this article, this news clip here is talking about what's happening in California. It's happening all over the country. What's happening is, let's say you have a house. It could be sitting there free and clear. It could be a rental. They're looking for them to have no liens on them, sitting around, maybe just vacant, whatever. They'll go in, they'll falsify some paperwork, they'll put a lien on it. If they own it, they'll change the deed over to their name. They'll turn around quickly, try to hire an agent, try to sell themselves. And, you know, how do you not get caught up in this scam or scheme? A couple things to look at. Number one is if you're dealing with a buyer, maybe that says, oh, you can buy this from me direct, and they won't meet up. They won't talk on the phone. They're very short. They're asking to wire money. It's very shady. You need to hit the pause button. You're hearing also an article where real estate agents even sign the purchase contract. They didn't even feel like it was right. So how can you avoid this if you're going to buy a house or somebody's going to scam you? It's very simple. Number one is, if you're a buyer, make sure that if you're dealing with one agent or two, that those seem viable agents. If you really want to make sure that that person really owns the house, you could have your lender say, hey, pull a property profile. There would be a chain of ownership on there, and you can avoid that. Number three, if they start telling you to wire money and change things as you go along, but they're kind of a ghost and they're MIA and you can't get them on the phone, and they want to do everything through text or an email, and it doesn't seem weird and shady. Trust me, when you're involved in this, you kind of sense it. So just be aware, because you can literally close on a home, buy it, then you realize they didn't own it. You get a loan, and it could turn out to be a nightmare where you have to unravel this whole mystery back to the original owner. So anyways, I wanted to share that story because this stuff is becoming more and more apparent. And with AI and things like that, you're going to see this kind of get out of control as people can do these things and find homes quickly. Remember, there's people every day that wake up, they go to work, and they're trying to steal money from you and I, and they're just trying to be dishonest. And even though they're not good people, and even though we can't trust them, we have to do our due diligence to make sure this shit doesn't happen to us, our family, our clients, anybody around us. So if you suspect this or anything like that, definitely reach out to local authorities and file a complaint. But this is getting, as you can see, this stuff is up and up more and more because there's so much real estate out there and people are just not paying attention. So Matt Graham with Mortgage Daily News. Let's see what his rate prediction could possibly be for next year and why. Let's get a quick clip here.
That initial drop in yields after the Fed's meeting yesterday has picked up even more steam today. The 10-year Treasury, remember, was at nearly 4.25% just on Monday, and today was down in the 380s. That plunge means the 30-year fixed mortgage rate is back below 7%, all the way down to 682, if not lower today, and that's its lowest level since mid-May. Let's bring in Matt Graham here. He's Mortgage News Daily's Chief Operating Officer. Matt, I'm seeing numbers even, 6.6% now.
That's right. Yeah, 6.62 was what I updated it to a short while ago. It's been a staggering 2-day move, one of the biggest 2-day moves we've seen.
Unbelievable. And then people were already running the analysis on social media, but saying, if you were one of the people who had unlucky few who had to buy at 8%, it probably already makes sense to refi.
Yeah, I mean, definitely that's the calculus, right? Sometimes as little as 0.5% can motivate somebody to refi, depending on what their motivations are, whether they need cash out, etc.
So what do we make of this dynamic for the housing market? 6.6% is still much higher than most people in their 40s, whatever their home buying audience is, are used to. It's better, but it's not great.
Right. Yeah, that's how they get you, right? Now we're excited for rates to come down to 6.6%. I think when rates were moving up and over 4 and 5%, this would have looked pretty bad. So everything's relative, but for sure, we've already seen the application data start to pick up even before the last 2 days of gains, talking about MBA's mortgage applications, and in the refi category as well. Now they're picking up from historically very, very poor low levels, but picking up nonetheless. And there's definitely a buzz that is increasing in the housing and mortgage market over the past 2 days.
What would you expect the rate to be into next year based on what the Fed said yesterday?
Oh, yeah, that's good. Get me with the predictions, right? I love those. So look, the rate momentum is as good as the trajectory of economic data. So if the data continues to do what it has been doing, there's no reason rates couldn't go down into the 5s, possibly even high 4s if, some of the talking heads are right about recession in 2024. That's not unreasonable to think that we could see that territory that quickly, but it really depends on economic data, chiefly inflation, getting to the 2% target.
And quick final question, but as most people in the market are well familiar, the spread is still historically wide. And is there any sign of that normalizing?
I wouldn't say there's a sign of it normalizing. It's coming down, and it makes sense to me where the spread is given the rapidity of the move toward higher yields. And it is something that should naturally come down as rates overall come down and as volatility sort of dies down.
And there you go, guys. So you're going to hear predictions. Matt from Mortgage News Daily saying basically we're projecting in the 5s, could be in the 4s with the recession. And what's going to happen really for rates moving forward, because everybody wants to know, are they going to go down? It's going to be a couple factors. Number one, we're going to be watching the economic data. Number two, we're going to keep watching what the Fed does. Obviously, if he cuts early, that is a signal that he needs to, because the economy is maybe slowing too fast. We're going to keep watching inflation. We're going to be watching the jobs market, watch the consumer, and then obviously continue to watch the 10-year treasury come down. We still have that spread. But if we do have to have a recession, which a lot of people are projecting in the second half of next year, they think, things are really going to slow down or get ugly. We could definitely see interest rates fall more dramatic in the conventional and the FHA. If FHA right now and conventional is already at 5, in the mid 5s almost, for us to see a 4 handle, 4 in front of that rate I think that's very realistic. I think conventional, could we see with a 4 in front of it? That would be insane. But if that's the case, that means we're probably have some bad economic data, and that's what we're dealing with. But anyways, guys, that's it for this week. It's a lot of data. I'm still fighting my voice, still coming off from being under the weather. So I might not be giving you all the entertainment and action and comedian and all that stuff you want. But I need another week to recover. And then next week, hopefully I can entertain you guys even more. But hey, we're almost done. It's 2023. As things slow down, as things get to the end of the year, I wish you and your family a Merry Christmas, because you will not see my brief until next Wednesday, and that's after Christmas. So happy holidays to you. Whatever you're doing, whatever you're celebrating, I hope you get some time off. I hope you get to enjoy it. If you need anything from me, please reach out. I'll be around and working. And otherwise, if you're on a trip and you're chilling and you're living it up, good for you. But hey, I look forward to 2024. Some exciting announcements on the way that will be coming probably late January. And there's a lot of good things coming out. So 2024, finally for real estate, hopefully we will start coming out of our recession. Things will pick up, and this will help home buyers, people refinance, and a lot of transactions get done, and get our real estate market back on track. As far as the other part of the economy, we might see a slowdown, could see a recession, but we'll have to wait and see. But happy holidays. Thank you guys so much. Love you all. Until next week, enjoy the week.